Right now, only 24% of homebuyers are purchasing their first house. That is the lowest level of first-time buyer participation seen in modern tracking. With mortgage rates hovering around 6.7%, the monthly payment for a standard starter home has practically doubled in just 2 years. For regular families relying on a bank loan, the math simply no longer works. When millions of people are priced out of a basic need, they look for a reason. Online, that frustration has coalesced into a single unified target. Across YouTube, TikTok, and X, users point the finger at Wall Street, blaming mega corporations for hoarding the housing supply and locking out the middle class. One specific name takes the brunt of this anger: BlackRock. The $10 trillion asset manager is at the center of a viral theory claiming they are secretly buying up American neighborhoods. This idea has spread far beyond internet comment sections, catching the attention of major political figures like Robert F. Kennedy Jr. The backlash has generated real-world policy. Over the last few years, federal lawmakers have proposed bills, and the president has issued executive orders, all designed to stop Wall Street from competing with Main Street for single-family homes. BlackRock explicitly does not buy single-family houses. They invest in mortgage securities and purpose-built apartment buildings, but they do not purchase existing residential homes. Much of the viral outrage stems from confusion between BlackRock and Blackstone. Blackstone is a separate private equity firm that actually does operate massive single-family rental portfolios through its various subsidiaries. But even if we look at the companies that actually buy homes, their footprint is remarkably small. This chart breaks down the percentage of investment properties by portfolio size. Mega investors, the corporations owning more than 1,000 homes, control just 2% of the national inventory. Furthermore, these massive firms are retreating. For 6 consecutive quarters, large institutional investors have been actively selling off more single-family homes than they acquire, rotating their capital into other developments instead. The world's largest, most visible corporations aren't the ones outbidding families for starter homes. This bar graph displays the percent of homes purchased by investors over time. Look at the dramatic spike on the far right. In the second quarter of 2025, investors bought 33% of all homes sold in the United States. To see who those investors are, we return to this ownership tier chart. The vast majority of these buyers are not hedge funds. 87% of investor-owned homes belong to mom-and-pop landlords who operate portfolios of 5 properties or fewer. These small investors consistently beat out traditional families because of their primary weapon, the all-cash offer. A family relying on a mortgage must clear hurdles like bank underwriting, rigid appraisals, and tight loan contingencies. A cash buyer bypasses the entire system. From a seller's perspective, a financed offer carries hidden risk. If an appraisal comes in low or a buyer loses their job right before closing, the entire deal collapses. Cash offers close faster and with near absolute certainty, making them highly attractive to sellers, even if the bid is lower. Untethered capital holds an undeniable structural advantage over the friction and red tape of the modern 30-year mortgage. Treating this single-family home as a high-yield asset accelerated sharply after the housing crash of 2008. In the wake of the crisis, millions of foreclosed properties flooded the market at deep discounts. Private equity firms stepped in to absorb the excess inventory, proving to the financial sector that managing thousands of scattered single-family rentals was highly lucrative and scalable. Economists call this process financialization. It occurs when global capital uses housing primarily as a vehicle for wealth accumulation. The United Nations Human Rights Council specifically identified this trend as a subversion of land's social purpose. Housing transitioned from a basic human necessity into a globally traded commodity, valued heavily for its yield potential rather than its utility as shelter. Federal lawmakers are actively attempting to regulate this environment. The End Hedge Fund Control of American Homes Act, for example, seeks to impose aggressive tax penalties and force large institutional investors to liquidate their single-family portfolios over a 10-year period. However, these policies miss the actual market mechanics. Banning hedge funds does nothing to address the individual cash buyers and regional landlords who hold 95% of the investor inventory. This data table compares average transaction prices. Notice the gap. Investors are purchasing homes at an average of $455,000, well below the national average of $512,000. Investors are strategically targeting older, cheaper properties that need work, taking that entry-level supply out of the pool. With the affordable starter homes absorbed by cash investors, regular buyers are pushed upmarket. They are forced to fight over a shrinking supply of premium, move-in-ready houses while trying to secure financing at heavy interest rates. Regular families are forced to compete for basic shelter in a housing market optimized purely for financial extraction.